Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 25th year in business. It's midday, Thursday, December 4th, and the title of this week's audio blog is Crashing Oil and Currencies, America's Death Knell. Now, I didn't write an article this morning, as between all the podcasts and my audio blog, Thursdays are getting a bit crowded. We'll see how this format works for a while, but have no fear, the Miles Franklin blog will continue to work 24/7, compiling all the news and commentary you need for your personal due diligence process, which truly is a 24/7 job, given how rapidly the global economy is collapsing and how many Washington, Wall Street, and mainstream media outlets have either abandoned the truth or no longer have the ability or brain power to dispense it. To that end, I found that recently I've spent more and more time scanning the headlines of MSM economic cheerleaders like Yahoo Finance, Reuters, and Bloomberg, frankly, as much for entertainment value as to understand how dumbed down the media has become, not to mention to seek changes in the public mindset, which, compromised or not, the MSM clearly must reflect if it wants to prevent already record low ratings from falling further. Lately, for instance, there are far fewer headlines pandering to Washington and Wall Street propaganda of recovery, which is a decidedly good sign. In fact, there appear to be more articles discussing the true decrepit state of America's economic affairs than blindly pandering to the party line of recovery, job growth, and American hegemony. Unfortunately, most such articles are painstakingly shallow, avoiding the real issues at hand, like market manipulation, for example. And now that, I kid you not, computer algorithms are writing many press releases, the copy within such articles often contradicts itself. Such as, for instance, the article I noted yesterday, in which the headline claimed stocks were up due to a bounce in oil prices, whilst the copy said stocks were up due to expectations of lower oil prices. In other words, the reasons to avoid traditional media outlets have never been stronger, which thankfully is the trend the entire world is headed, in favor of the diversity, impartiality, and truth of the alternative media, i.e., the internet. Regarding the aforementioned zeitgeist, one item Yahoo Finance was dead right about was highlighting an article from another economic cheerleader turned realist, the Wall Street Journal, titled Dodgy Home Appraisals Make a Comeback, which simultaneously was discussed by my good friend Mike Krieger of LibertyBlitzkrieg.com, who represents the polar opposite of mainstream economic reporting. In it, the article describes how the mid-2000s practice of appraisers being pressured and in some cases paid to inflate home and income appraisals is back in vogue. Mostly, this has occurred due to mortgage originations plunging to a 19-year low due to a lack of home affordability caused by the latest Federal Reserve generated real estate bubble and the worst economic conditions and credit availability to the 99% since the 2008 lows. However, just as guilty is the utter lack of regulation reform of securities securitization or restraint from the government's zombie vassals Fannie Mae, Freddie Mac, and the Federal Housing Authority. In other words, subprime lending and mortgage fraud is back with a vengeance, not just in the housing market, but across the entire economy. Only this time around, our near-communist government is running the show, with dramatically weaker finances and nearly non-existent public approval. To that end, this story was particularly germane to me, given what I observed personally last week at a Nissan dealership. This month, the lease on my wife's car ended, so we went car shopping looking for year-end lease deals. While at the Nissan dealership, a family sat down at my table while my wife was test driving a car, and inexplicably, the Nissan salesperson sat down as well, proceeding with the credit check process right in front of me without asking me to leave. As it turns out, this single mother of two wanted a loan for nearly the full value of a new car, and the only proof of income she could supply were a handful of pay stubs that were several months old from Domino's Pizza. The salesman had that look in his eye like he'd essentially consider anything good collateral. So when she said, "I really make more than that, I promise," he didn't even flinch. I'm going to take a wild guess that she got the loan, adding to the already record level of subprime auto loans taxpayers will shortly be forced to subsidize, let alone if record low interest rates even modestly tick higher. Of course, as I have been practically screaming for the past year, rates will decidedly not rise. But instead, as typified by the action of the benchmark 10-year Treasury yield, any sovereign bond that doesn't default first, like Venezuela, Russia, or Greece, for example, will see yields fall to Japan and Germany like levels below 1%. That is, until hyperinflation inevitably arrives, destroying whatever value the dollar, euro, yen, and the rest of the world's fiat trash still derives. Until then, the collapsing global economy and ongoing central bank put of central banks as diverse as the Fed, ECB, BOJ, BOE, PBOC, and of course, the Swiss National Bank will expand the Ponzi scheme to its very end via QE and ZERP to infinity schemes that must continue to grow to prevent instantaneous economic implosion. In other words, per the title of last week's audio blog, the entire world is front-running the central bank's unrelenting money printing and market manipulation, knowing full well they will monetize everything and anything from stocks to bonds to the economy, both overtly and covertly, until the bitter end of history's most destructive monetary experiment, which in our view looms far sooner than most can even imagine. Since last week's audio blog, OPEC did exactly what I expected it would do, i.e., expand its most vicious price war with the West since the 1980s, which, if you recall, utterly devastated America's energy industry for more than a decade. Ironically, in OPEC's primary function of supporting prices, it creates an artificial price environment of overinvestment, particularly in high-cost markets. You know, like the Federal Reserve creating real estate and equity bubbles by artificially depressing interest rates. Or, for that matter, the cartel utterly destroying the mining industry, likely for decades, by covertly suppressing gold and silver prices. Anyhow, the economic dislocation OPEC has created, in spite of the fact it has less operating leverage than in the past, is as historic as the aforementioned subprime lending bubbles, which is exactly what high-yield debt-financed shale drilling is, subprime exploration and production. In this case, even historic money printing has not been able to overcome the plunging energy demand characteristic of the world's worst economic conditions since the 1930s. And in this context, where current oil production is well over a million barrels per day above consumption, the ingredients for a 2008 style oil price crash are all in place. But even if prices don't get to the catastrophic 2008 lows of $40 per barrel, today's level of $66 per barrel, which equates to closer to 50 to 55 per barrel realizations for the subprime grades produced by major shale fields like North Dakota's Bakken, is not only enough to destroy the vast majority of the shale industry, which makes up an astounding 15% of the entire U.S. junk bond market, but more than a third of America's entire industrial capital expenditures, which is exactly what energy currently accounts for. And keep in mind that, like the mining industry, energy exploration was already in steep decline before the fall's historic price collapse, given that peak cheap oil was long ago reached, just as peak cheap gold, silver, and many other valuable commodities have. In other words, America's already collapsing capital expenditure environment is on the verge of a dramatic stair-step downward, plunging it so steeply into recession that even the government's best book cookers will not be able to mask it. Oh, there is one thing America has dramatically increased capital spending on, care of the Greenspan-Bernanke Yellen put, inherent in the God's work performed by the Fed, PPT, ESF, and gold cartel, which is, of course, debt-financed stock buybacks, which in sum total have added hundreds of billions of debt to corporate America's balance sheet in repurchasing more than 10% of the entire New York Stock Exchange stock capitalization at historically high valuation levels. Gee, I wonder how that will turn out. Of course, the most damning evidence of central bank destruction is the utter collapse of global currencies, which at this point are tumbling like dominoes at a pace not seen since the 2008 crisis lows. Only this time, neither sovereign governments nor their captive central banks have either the balance sheets or public support to bail out their economies with additional money printing. Oh, they'll certainly try via either executive order or covertly, but exponential debt growth cannot be hidden. And when you're already long past peak debt, every additional dollar, yen, euro, or yuan printed only makes things worse. To wit, I wrote earlier this week of how the U.S. national debt, excluding off-balance sheet items and unfunded liabilities, of course, topped $18 trillion last week, nearly $4 trillion higher than when S&P stripped its AAA rating just 3 years ago. All that money printing, plus untold additional trillions of swaps and other covert printing schemes, and America's labor participation rate, real household income, government approval ratings, and cultural advancement are at multi-decade lows, as are corporate expenditures, capital expenditures, family formation, and homeownership, among others. To be fair, numerous categories are, conversely, at or near all-time highs, like entitlement payments, government spending, debt, and the cost of living. Back to the currencies. I earlier this year wrote the unprecedented economy-killing volatility catalyzed by the final currency war, i.e., the terminal phase of history's largest fiat Ponzi scheme, was the single most precious metal bullish factor imaginable. However, even I'm in awe of the dramatic declines countless currencies have experienced and are as we speak this morning, with the average currency down more than 30% against the dollar since the Federal Reserve took QE into hyperdrive 3 years ago, and nearly 50% for the Fragile Five currencies, that is Brazil, India, Indonesia, South Africa, and Turkey, where more than a quarter of the world's population resides. This is what I mean by the issuer of the world's reserve currency exporting inflation, as in the mad rush of competing central banks to devalue their own currencies, the lack of liquidity lesser currencies engender causes dramatic depreciation. Oh yeah, and the giant pink elephant in the room, i.e., expanding fear of global economic collapse, which has caused capital to race to safe haven assets, in quotes, of course, like the dollar and government monetized assets like sovereign bonds. Worse yet, any currency even remotely related to the commodity production, from the Australian dollar to the Venezuelan bolivar, the Brazilian real, South African rand, Indonesian rupiah, Nigerian naira, and Russian ruble are in utter freefall, which is why I can only chuckle at the relentless deflation propaganda, such as that proffered by Mario Draghi at this morning's ECB meeting, let alone calls for the dollar index to fall to 50 and below, when more likely it will reach 150 before hyperinflation inevitably sets in, destroying all fiat currencies' purchasing power. Of course, if markets were freely traded, this money would be flocking to physical gold and silver, just as it did in 2008, when after the cartel's initial blitzkrieg attack in the fall, surged to new highs in the spring of 2009 when physical supply sold out following the ridiculously blatant paper raids of October and November. Today, just 5 years later, the power that be's manipulation arsenal of derivatives, swaps, and high-frequency trading algorithms is much broader, as depicted by yesterday's CME website posting of an extension of volume trading discounts to central banks so they can manipulate markets as diverse as gold, silver, oil, cotton, and S&P futures. And thus, despite record physical demand for both gold and silver at orders of magnitude above the 2008-2009 levels, they have incredibly managed to push paper prices well below the cost of production. Unfortunately for them, the lower prices are catalyzing still greater demand, particularly in silver, as I wrote about yesterday. Whilst the mining industry has been so decimated by surging costs, capital strangulation, government taxation and regulation, and an historic personnel exodus, that not only has the production unquestionably peaked, perhaps permanently, but the declines I anticipate in the coming 3 to 5 years could be unprecedented. According to the consensus of last month's Miles Franklin Silver All-Star webinar panel, which can be accessed for free at milesfranklin.com, a silver production decline bordering on 50% is not out of the question given the damage done by the past 3 years of price suppression, atop an industry that was already in a state of severe secular decline. Wow, it just occurred to me that I've typed 4 pages of copy already and not even mentioned the Swiss gold referendum, other than, of course, to mock the Swiss National Bank, which just committed itself to a QE program far more advanced than even the Bank of Japan, in self-immolating itself in the cause of pegging the franc to the dying euro. As I write, the franc euro is essentially unchanged from Sunday night, after the Swiss people, whether manipulated or not, voted unanimously to allow unfettered franc devaluation. In other words, the market knows full well the SNB will eventually fail, causing the peg to be overwhelmed by the sheer reality of the situation. Heck, the S&B has already tripled its balance sheet in just 3 years of defending the peg, bringing it to an astonishing 80% of GDP, compared to, for instance, 20 to 25% of GDP for the Fed and the Bank of Japan. And this with the GDP of Switzerland at essentially flatline for the entire 3 years, and their cost of living at a record high. And when the peg does fail, the entire Swiss nation will realize it was duped by propaganda and market manipulation into voting against the one measure that could have saved it. Most of the people that voted no did so purely due to propaganda that their manipulated stock market would fall if the franc rose in value, which in itself is ridiculous, and the rest because the cartels so viciously attacked gold prices in the preceding weeks, particularly in the thinly traded Black Friday trading session that conveniently preceded the vote. Once that peg is broken, and likely the financial world is amidst outright chaos, there will be a lot of angry Swiss as gold and stock prices dramatically reverse roles. As for my thoughts personally, I was truly hoping the people would strike a blow against evil by voting for the referendum. However, at this point, the power that be's cumulative manipulative abilities were clearly too strong to allow free thought to prevail. They, of course, will ultimately lose their war against truth miserably, and frankly, all the no vote accomplished was abdication of the last remaining hope for central bank responsibility, giving 7 billion global denizens absolutely zero protection options other than precious metals. Would the cartel have been broken by a gold rush if the vote was yes? We'll never know, although I suspect they would have, at the least, been severely crippled. However, in the post-no world, mere days afterwards, I see nothing but expanding economic calamity, currency volatility, and plunging interest rates, which, per above, are exactly what catalyzes major financial crises, let alone expanding geopolitical tensions, particularly in the Ukraine, representing the growing cadre of potential black swan events that could topple all the power that be's best laid manipulations in an instant. To wit, this morning's machinations cannot be more evident of the economic cancer engulfing the world. At the ECB's meeting, they of course maintained rates, as only if stock markets were plunging would they be motivated to take rates that were already negative even more so. To that end, the irony of Germany's DAX index hitting an all-time high this morning as Germany unofficially enters recession, the euro challenges its mid-2012 whatever-it-takes lows, and pigs like Greece are on the verge of default, is a testimony not only to global PPT operations, but the unprecedented lunacy of the Draghi put and other QE to infinity programs. Of course, amidst such bullishness, the ECB slashed its inflation expectations to essentially zero, whilst interest rates from Japan to Europe to the US have plunged in anticipation thereof. The euro modestly blipped higher, bouncing from the 1.23 level representing the aforementioned 2012 lows, and in my view, the only reason it didn't plunge further was because Draghi's carefully worded his speech with slightly less dovishness, no doubt heeding the Fed's recent warning not to take the euro devaluation too far. After all, Draghi already accomplished his goal of euro devaluation by simply jawboning of QE to infinity, and thus there was no reason to push the envelope this morning. Of course, as the global economic conflagration accelerates, the aforementioned rush to the dollar, particularly from cratering economic unions like in Europe, will be a sight to behold. I would be quite surprised if the euro doesn't plunge through 1.2 in the coming months, just as the yen, which breached 120 to the dollar for the first time in 8 years this morning, seeks 140 to 150, en route to potentially its old lows in the 300 plus range, which would yield an utterly nuclear expansion of the global currency wars, particularly from its neighbor and rival China. For that matter, yen-priced gold is now just 6% from its all-time high, and thus, for all those secular Americans out there that believe the world revolves around them, keep in mind that the world's other 6.9 billion people price gold in other currencies, which on average are no more than 20% from their all-time highs. And if there's one thing gold owners know, it's that its unique inelasticity causes demand to dramatically increase with prices. Speaking of economic conflagration, how about the world's strongest economy? You know, the United States of economic lies. Amidst last week's Swiss gold hullabaloo, we actually saw 9 economic data points below expectations in one day on Wednesday, including a massive downward revision of the past 6 months' new home sales data. As usual, the only data points that weren't dramatically lower were the island of lies diffusion indices, which themselves have been declining, particularly in key categories like employment. Moreover, the third quarter was perhaps the worst for corporate earnings since 2008, with more outlook reductions than any in memory, from a broad swath of industries, both domestic and international. And for the coup de grace, Black Friday holiday sales were a whopping 11% below last year's 5-year lows, compared to expectations of a significant increase. Worse yet, brick and mortar market share plummeted relative to online, setting up an utter implosion of retail employment and commercial real estate values in 2015. Heck, yesterday's ADP employment disappointment depicted its first November decline in 4 years and worst print since, drumroll please, 2008, at the heart of America's worst financial crisis since the Depression. Frankly, I can't wait to see what the BLS data cookers publish tomorrow, given not only accelerating economic weakness, but an unfriendly birth-death model month, which typically generates a modest negative number. Better yet, given that the vast majority of purported 2013 job gains were retail-related amidst the worst retail environment since 2008, how can the BLS possibly continue to purport retail job growth at all, let alone the more likely scenario of job contraction, which I might add is all but guaranteed the second the holiday season ends. As for precious metals, notwithstanding Monday's post-Swiss referendum surge, in which the cartel clearly covered the naked shorts they so desperately piled on to prevent a yes vote, the suppression algorithms have never been more blatant or unrelenting. Just this week alone, I could write a book. Just this morning, I could write a book on their maniacal attacks. But suffice to say, the entire world is becoming aware of the gaping, unprecedented gap between paper prices and physical supply and demand. In yesterday's upcoming inevitable silver shortage, I highlighted some of these incredible statistics. But one need not look further than historically negative forward rates, plunging exchange inventories, and record demand in India, China, and even the US and Canadian mints to realize something's gotta give, and soon. Finishing the thought, Western PM sentiment is at lows not seen since before the 15-year bull market commenced, yielding the best evidence yet of what intelligent investors should be watching. Heck, one of the most popular PM-focused websites, which I won't name, but many of you can guess, has a top story this morning, in fact, the top story, claiming analysts, I'm not sure which analysts, see short-term boost for gold and the euro Thursday with no new ECB QE. In other words, they actually believe that it would be more favorable for gold if the ECB does not print more money than if it does, under the ridiculous assertion that the resultant decline in the dollar index, no matter how small, would be positive for gold. To that end, not only has the dollar index has had essentially zero correlation with gold for the past 8 years, but common sense would tell even the most unsavvy financial investor that money printing is better for gold than monetary restraint. All we can say to that is this: run, don't walk, to your nearest precious metals dealer, hopefully Prime Miles Franklin, as the global fiat Ponzi scheme, by definition, will not only expand in the coming weeks and months, but exponentially so. And when Janet Yellen is forced to finally rejoin the party, overtly that is, the end game will truly be nigh. Lastly, I want to encourage all readers to purchase the brand new book titled No Delight in Fools by my good friend Damien Bush. No, I'm not getting paid to recommend this book. I just happen to have read it in its draft form, as it is an entertaining fictional account of what America might look like after a dollar crash. In fact, I was so inspired by it, I wrote an entire article on it when I read it 9 months ago, titled The Post-Fiat Future, which is also on milesfranklin.com. It's available on amazon.com for $16, and I truly believe you'll love it. Well, that's enough for today after 7 pages of copy. I'm dying to see if the BLS has the gall to follow yesterday's ADP disaster with a, quote, better than expected number tomorrow, given that essentially all measures of November economic activity have been miserable. Oh well, if they do, which I'll take the under on, you can bet the internals will be worse than ever. I mean, seriously, the concept that the majority of job growth, even including 6-week contracts for holiday FedEx drivers, could be in retail when not only is retail dying, but brick and mortar retail in freefall is downright comical. Have a great weekend, and if you do decide to protect your assets with precious metals, we hope you'll give Miles Franklin a call at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thank you.